This is Amit Pabari, founder and managing director of CR Forex. Last week we saw that US debt ceiling issue kept pressure on the dollar index. As I am recording the video, there is a 95% probability that the US debt ceiling issue will be resolved. But it is not going to stop DXY to move higher because US economic data is much better as compared to other economies like Europe and UK. Second, Germany has technically reached into a recession. The last week data point was showing that. Third, Asian currencies are continuing to move higher, especially Japanese currency and Chinese currency. Fourth, we have seen that RBI protected a key level of 82.85 and did not allow it to move towards 83. Now let us discuss what is the outlook for coming week. In last 1 month, the pair has moved in a single straight direction from 81.60 to 82.85 kind of a level. Generally, when the pair is moving in a straight line, after that the pair entered into a consolidation phase. Probably the coming week is such a week where the pair will enter into a consolidation phase where 82.85 will act as a strong resistance for the pair and 82.40 and 82.20 will act as a strong support for the pair. Saying all of this, I will say that there is a 60 to 70% probability that the pair can move towards 82.40 and 82.20 because of corporate inflow and RBI intervention at higher levels. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Lot of them have taken costing close to 82.50 to 82.60 last week. Now when you are taking an aggressive kind of a costing, what should be the ideal strategy? It seems that RBI has defended 82.85 last week and probably the pair will enter into a consolidation phase between 82.20 on the lower side and 82.85 on the higher side. In such kind of scenario, it does not make any sense to keep your position open. So we'll suggest that you should cover 100% between 82.60 to 82.80 kind of a level. If anyone wants to wait, they should keep a strict stop loss of 82.55 and wait, or 82.50. If the stop loss is breached, they should ideally cover 100%. There is a classical mistake what a lot of thin margin exporters do is that they take aggressive costing when the rupee is trading at the higher level and they miss to keep their stop losses. So avoid that mistake this time. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporter. If someone is covering against confirm order, then ideally they can increase the hedge ratio from 50% to 70% and they can cover between 82.60 to 82.80 kind of a level. Now if someone is booking under anticipation basis, it means that if आपका turnover 100 करोड़ है पूरे साल का और आप उसका 50% कवर करते हैं 50%, then in that case we will suggest them they should not increase their hedge ratio beyond 50%. There are primarily 4 reasons for the same. Pehla, premiums are extremely low and volatility is high. Dollar index is still in an uptrend. All Asian currencies are depreciating, or we can say getting weaker against dollar. Rupee has not got weakened as compared to other Asian currencies. And finally, India still have a trade deficit problem, because of which it can be a situation that on the second part of the year the currency might get weaker. Because of all of this reason, suggesting them not to increase their hedge ratio beyond 50%. Now let us discuss strategy for importers. When the pair was trading near 81.80 level, we suggested importers that they should ideally be covered till June end. And those who have missed covering at lower levels, suggested them last week that they should keep a stop loss of 82.85 and wait. Ideally, the same strategy applies for this week also. If anyone has missed covering their June import, they should keep a stop loss of 82.85 and wait, because there is a 60 to 70% probability that the pair can move towards 82.40 and 82.20 kind of a level. Near those level, we will decide whether we want to hedge or not. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.